Welcome to Eureka Street Crypto. This is my anti-professional crypto channel. I'm just a barely sane dude who fell down the cryptocurrency rabbit hole. This channel is my fumbling attempt to communicate myself outside my own head about my journey in the crypto space. It is basically my brain dump. None of this is actual financial advice.
Good morning, everybody. I'm Eureka John, and you're at Eureka Street Crypto, broadcasting live from Leander, Texas. It is 6:16 in the morning on April 15th, 2022, tax day. It is episode 400 and yesterday was episode 446. It is episode 447. So let me go ahead and change that on the screen for those of you watching. So you can watch on YouTube, or you can listen on Spotify, Apple Podcasts, Google Play, all that crap. And this is my morning show, my brain dump, and it still says Thursday. Let me change this Thursday over to Friday. Today is Good Friday. I hope you're having a good Friday so far. It is a holiday for me, for work, because my job celebrates Good Friday and Easter because it is, well, it's not a Christian-based organization. It's just a factory, but the owners, decided to celebrate Good Friday, which I'm thankful for. And so let's see here. The cat's too busy trying to get in that door again. What do you want in here for, cat? Why do you want to come in here? It's just sitting there, just rattling the door. Just like, how does that cat have that much strength? First of all, that's just, man, I don't know. Cats are weird, and I didn't vote for the cat. Like I said yesterday, I was outvoted by 3 girls in the house, and sometimes it happens. Okay, so episode 447. It is Friday. It is Good Friday. It is tax day. I already did my taxes, and I don't make a lot of money, so I got a really good tax return back. But then the government came in. I sent in my tax return form, and they're like, "Yeah, we'll go ahead and just take 4/5 of that because of the child tax credit airdrops that I got that I didn't ask for." Yep. Oh well, it is what it is, man. Yeah, I was surprised I got anything back after they asked me if I had any cryptocurrency, and I said yes, I have cryptocurrency. I haven't really done a whole lot with it except just kind of dollar cost average. So, and there really was no other questions besides it. So I don't know, man. I mean, I have my real job, and most of the tax stuff is paid in there. If they ask, I'll try to supply them with as much information as I can. But right now, I don't really know what else to do. So it's not like I'm a trader, and I didn't really cash out tons of profits. So I don't know. We'll find out. So far so good. They went through and looked at everything, and they approved my tax return. And after they took out 4/5 of it because of the child tax credit, child care airdrop thing that they've been doing, and whatever, man, whatever. At this point, nothing surprises me. I'm just kind of just like rolling with the punches, Anyway, so let's go over here to CoinGecko and let's see what's happening. Say. All right, so let me pull up the old CoinGecko. Why does it look like this? I've had everything all looking pretty, and then my software crashed on me. Then I opened it up and just decided to go live, and here's what I get. So that's what happens. Yeah. All right, so CoinGecko, let's get this looking all pretty on the screen for you. Sorry for you audio listeners. Okay, all right, so Bitcoin's sitting at 40,300. Oh, let me just go ahead and refresh this page, because you never know. It could just jump up by $10,000 in the matter of an instant. Okay, but it didn't this time. Okay, so Bitcoin is sitting at $40,358.53. Everything's sitting pretty low because yesterday was a pretty big dip, and most cryptocurrencies. Ethereum's at $3,037.18. All this stuff is enough to make the somebody who's used to the stock market's butthole pucker. The way that cryptocurrency just kind of jumps around and is volatile, and we can't get into that market is too volatile. Yeah, it is. That's what's make it fun, man. Like, don't put in more money than you can afford to lose. It's the golden rule of, investing in general, period. So, all right. So XRP is at 78 cents. Solana is at $102.11. Cardano is at 95 cents. Terra is 81.92. Avalanche is 78.24. All of it's down in the red over the past week, that is. And except XRP is up 7.8% over the past 24 hours. I don't know why. The Doge. Okay. I don't know if you've seen all over the news, Elon Musk bought like a huge portion of the shares of Twitter, and then he declined being a part of the board of Twitter. And probably because he didn't want to go where he wasn't wanted, and everybody's, a lot of people, I guess, on the left are worried that he's going to, take over the platform and allow all this free speech on there. And, I don't know. I mean, and that he might just outright buy Twitter, and I think that would be cool. I mean, Elon, regardless of what some people think about, I think he's a pioneer. He's a renegade. He's a maverick. He's just kind of like, he's got FU money, and he's just trying things out, man. And I've kind of, in my own little way, follow along the same spirit. I just like to try things out and see what happens. And if it doesn't work, all right, man, we'll just move on to something else. And, he kind of, shares that same spirit. So I'd like to see what happens with Twitter. And, once Elon Musk gets a hold of the reins. And I saw on Twitter that, somebody had speculated, well, what if Jack Dorsey, the original founder of Twitter, bowed out on purpose in advance to let Twitter be, taken control of by the powers that are now in control of Twitter. And then he distanced himself from Twitter. And then now Elon Musk is going to come in. And he knew that Elon Musk were to come in and buy Twitter. And then Jack Dorsey would be brought back in to run Twitter the way that he would want to with Elon Musk. I mean, can you imagine Jack Dorsey and Elon Musk both running Twitter together and what that would look like? I mean, I think it could be pretty cool, man. Honestly, I'm just all here for the fun. I'm here for the party, man. That's it. So I don't care whether Twitter succeeds or tanks. I mean, I do have a couple shares of Twitter stock, but it really does not matter to me. I just want to see what'll happen. I mean, so already Twitter has implemented Bitcoin. Jack Dorsey's real bullish on Bitcoin. He's a Bitcoin head, and although I don't think he quite, I don't know, but yeah. And then Elon Musk loves that Dogecoin, and I don't know if he loves Dogecoin because he actually loves Dogecoin, or if he's like kind of just trolling everybody with Dogecoin. The fact that it's a useless meme coin, and the fact that it would be funny to him to put Dogecoin as a currency and a tipping mechanism and everything like that on Twitter, and to install it as part of the Twitter operations, and then also have Bitcoin on there as well. And I mean, that would be like the biggest trolling operation on just the wider general public, and it would drive so many people absolutely insane. So hey, man, bottoms up, dude. My kombucha tea. Let's do it, man. Let's put Elon Musk and Jack Dorsey in charge of Twitter and see where it goes. Crypto Twitter would certainly get a laugh out of it, that's for sure. Anyway, yesterday I was talking about Celsius and how Celsius had, basically kowtowed to the regulators, and they, as of April 15th, I believe, today, they are making it to where if you are not an accredited investor, then you cannot receive the interest payments and I don't know about lending. I think I read the article yesterday, and it's already just kind of gone in one ear and out the other ear. But you can't do a lot of functions on Celsius. You can only just swap and then keep your money on there, and that's it. That's not a whole lot for U.S. investors. So basically, I pulled all my money out of Celsius like a week ago, already in fears of this entire cyber, impending cyber attack and everything like that. I don't want my stuff on a centralized exchange. It's a good idea to take your stuff off of centralized exchanges, put it in a hardware cold wallet, or at least just like an online wallet that you have the seed phrase to. So make sure you hold on to that seed phrase. Don't give it to anybody. And so I have, my Bitcoin in cold storage and other stuff, and in wallets online that I hold the seed phrase to, decentralized wallets. I took everything out of all centralized places, and I did it because of the impending cyber attack. But now it just so happens that Celsius as well is now only allowing accredited investors. And what an accredited investor means is that you have to have, and I believe in the U.S., like something like $250,000 worth of money in your bank, and you have to have $1 million worth of assets, and only then are you allowed to trade. And I found out about accredited investing in very early 2020. Whenever I was studying up on XRP and stuff like that, like a lot of people do when they first get into crypto, because XRP was at that time between 2018 and 2020. And I was just about ready to sell off my XRP, whatever, because I ended up started thinking it was lame. There was something called Shares Post. And this was right when Ripple was about to go public, but you could jump in and buy shares of Ripple before it would go public through something called Shares Post. And you could do this with a lot of companies. It wasn't just Ripple. And, I went down through Shares Post and I was looking at it. And hold on, let me see if I can pull up the website. Shares Post. All right. Whoops. And then I'll just do stocks. All right, Shares Post stocks. And I was looking at the website, and there were a bunch of companies in there that I would have liked to invest in because of the fact that I study and research so much. And there are a lot of people who are not accredited investors and don't have all those assets that do their due diligence and really, would love to be able to buy this pre-IPO initial public offering stuff and to be able to invest in some of these things. However, I put in my, I signed up to Shares Post, and I got an email back saying, wanting my information, wanting my financials to make sure that I'm an accredited investor. And I was like, what in the hell is this? And then I read the requirements, and I was like, dude, I do not have 250,000 spare dollars just sitting in my bank account. This is absolutely ridiculous. And so I wasn't able to partake in that activity. They think anybody that doesn't have, that type of money is not, it's just total institutional discrimination and segregation based on financial, what you have, and that's what a lot of people are fighting over. All these other issues, about, what your skin color is, who you bone at night and stuff like that. And really the real discrimination happens at the institutional financial level. And that's how, where a lot of this stuff happens. And nobody sees that, they're just too focused on what the media is telling us to focus on. So enough, end this rant about that. But yeah, so I'm not an accredited investor. I couldn't do the Celsius thing. And then it led me, to think about some of these other podcasts that I've been listening to. And it made me think about this podcast here. Where was it here? This podcast right here with Jamie Catherwood on the Investors Podcast Network. And we started talking about Tulip Mania. He started talking about bucket shops, other types of bubbles and stuff like that happen. And a lot of these bubbles happen whenever, the lower classes, the people without all the financial, stability and foundation to sit on and nestle their butts in, and yeah, they sometimes set up things and do things a little irrationally out out of, in a way, sort of desperation. Everybody wants to get rich, right? And anyway, he talks about how the tulip mania didn't exist, and I will go there in a second, okay? But I want to talk first about bucket shops. Okay, so suddenly I'm basically being kicked out of all the benefit and the reason why I signed up for Celsius Network. So, it puts me back into DeFi, and a lot of DeFi stuff, and a lot of exchanges and a lot of things you'll find in the cryptocurrency world are a little, they can be a little scammy and shady and risky, highly risky. A lot of stuff is major leverage, which means that you are basically putting in money and you're betting like 1,000 times out, and you're making a large bet and you could lose everything if something were to go below your call on that. And it's leveraged trading is very dangerous and risky, and you could lose everything you put in. And a lot of people think that they can handle the market and predict the market and time the market, and they can't. Anyway, so they started talking about bucket houses, and I went in, and the whole concept of bucket shops really intrigues me. So let's go take a look at bucket shops. And I went on to, there's a Wikipedia definition and there's an Investopedia definition. So let me just go first into this Investopedia definition. All right. So what is a bucket shop? A bucket shop is a brokerage firm that engages in unethical business practices. Historically, the term was used to refer to terms that allowed their customers to gamble on stock prices, often using dangerously high levels of leverage. More recently, the term is associated with firms that practice bucketing, which involves profiting from a client's trade without their knowledge. All right. So bucket shops were set up in the 1870s. And they were basically houses. This is right around the time when the telegraph machine was invented. And supposedly they had this feed and this telegraph machine, and they could see what was going on in the stock market. And then cities all over the nation would all gather in these bucket houses and the bucket shops, and they would bet on the stock market activity. Now, when people were buying these stocks, they weren't actually buying the stocks. They were just buying a little piece of paper that the bucket shop said that you had the stock, even though everybody knew that you didn't actually have the stock. But what they were doing is they were abstracting the prices from the actual stock market and the actual stocks, and they were just basically paper trading, And paper trading is whenever you don't actually buy the stock, you just buy you just are sitting here tracking the price of it. And it's always good if you're trying to learn how to do the stock market or the crypto market for that matter, to do some paper trading for a while to kind of get used to the rhythm and the activity and the flow and everything like that, and a lot of the terminology and stuff like that. So bucket shops are brokerage firms that have clear and unmitigated conflicts of interest with their customers. So, Investopedia just comes outright and just is like flailing on how terrible it is, where Wikipedia is a little more objective. Traditionally, they functioned as gambling houses in which customers were encouraged to take on substantial leverage in order to speculate on future stock prices. When customers occasionally profited on their trades, the gains would be advertised by the bucket shop to recruit new customers. In most instances, however, the customers would face large or even total losses, as with all gambling activities. The bucket shops benefited from their customers' losses. Bucket shops became common in the late 1800s when the spread of a new communications technology such as the telegraph made it possible to speculate on stock prices in a timely manner. Bucket shops emerged to let clients gamble on stock prices in the same way that they might otherwise bet on racehorses. So when they say one possible explanation for the origins of the name bucket shop has to do with another technique used by these firms to profit off their clients. After executing their trades throughout the day, bucket shops would sometimes throw the trade tickets into a bucket. After mixing the tickets together, the firm would then allocate winning and losing trades to specific clients based on their assessment of which clients would likely generate the most profit for the firm. The practice is, of course, prohibited by today's legal and regulatory standards. I don't really like Investopedia's take on this. It's very biased, and it just, and I don't think it's correct. Wikipedia actually did a better job here. A bucket shop is a business that allows gambling based on the prices of stocks or commodities. In 1906, U.S. Supreme Court ruling defined a bucket shop as an establishment nominally for the transaction. Nominally is the key word, for the transaction of a stock exchange business or similar character, but really for the registration of bets or wages, usually for small amounts, on the rise or fall of prices of stocks, grain, oil, etc., there being no transfer or delivery of the stock or commodities dealt in. A person who engages in the practice is referred to as a bucketeer, and the practice is sometimes referred to as bucketeering. All right. Bucket shops were found in many large cities, but from the mid 1800s, but the practice was eventually ruled illegal and largely disappeared by the 1920s. Okay, so according to the New York Times in 1958, a bucket shop is an office with facilities for making bets in the form of orders or options based on current exchange prices of securities or commodities, but without any actual buying or selling of the property. Bucket shops are sometimes mentioned together with boiler rooms as examples of securities fraud, but they are distinct types. While a boiler room operator seeks to broker actual security trades, the bucket shop's emphasis is on creating the appearance of brokerage activity where none actually exists. The origin of the term bucket shop has nothing to do with financial markets. Okay, so I think this is pretty interesting. As the term originated from England in the 1820s, during the 1820s, street children drained beer kegs which were discarded from public houses. It sounds a lot like me in high school. The street children would take the kegs to an abandoned shop and drink them, and then the practice became known as bucketing. And the location at which they drained the kegs became known as the bucket shop. For me, it would be under the bridge at Highway 59. You take the keg down there, all the kids down there drinking off that keg until the cops show up. So anyway, the idea was transferred to illegal brokers because they too sought to profit from sources too small or too unreliable for legitimate brokers to handle. The term bucket shop came to apply to disreputable sham brokerages that did not execute trades. Sounds a lot like kind of shady DeFi derivative exchanges. I mean, I know synthetics is not shady, but I mean, really, they're derivatives. I mean, the whole thing, the whole idea of the real estate crash and everything like that in 2008 was focused around derivatives. Derivatives are whenever you are buying something that is pegged to the price of something else, and that tracks that price. It's a derivative of that. And that's basically what they're doing here. They're just not doing it with the big money approval, And so my point was about the whole Celsius thing, and then how I suddenly have to be an accredited investor to partake in some of this activity and all this regulatory stuff and this institutional systematic discrimination set up according to people's finances forces people to kind of who want to do well. And if you want to get rich right now in the crypto market, you're not going to do it with Bitcoin right now. If you're not coming from already established, well-off financial means, you're going to have to be a degen. You're going to have to go in and learn some of this risky DeFi technology, maybe do a couple, stupidly, crazy trades, and one might work out well. And it's kind of a lot of these DeFi stuff, especially on things like Binance, are kind of the online version of bucket shops, and I partake in some kind of bucket shop like activity online, and there is a lot of scammy behavior and a lot of crap that goes on in these bucket shops that were not in favor of the person who would go to these bucket shops trying to get rich, and a lot of the people running these bucket shops would take advantage of it. So bucket shops specializing in stocks and commodity futures appeared in the United States in the 1870s, corresponding to the innovation of stock tickers upon which they depended. And I think about oracles in crypto. Chainlink is an oracle. Band protocol is an oracle, and those are basically little snippets of code and pieces of software and protocols that allow information to be funneled from the real world, such as real-time stock prices, real-time, crypto and things like that, from exchanges to be, or from sources to be funneled to exchanges and to be funneled to things like CoinGecko. Like I showed you the prices this morning. CoinGecko uses oracles, Chainlink oracles, in order to get real-time updated pricing information, that's kind of what the telegraph machine was during that time, and the stock tickers were. Those were the telegraph machine was the oracle that transmitted the stock ticker information all over the United States to every single bucket shop around there. So in 1889, the New York Stock Exchange addressed the ticker trouble, these bucket shops operating on an intraday stock prices movement, and they attempted to suppress these bucket shops. So think about this. A lot of times when we think about history, we're just reading it back to back. 1870 this happened, 1880 this happened, 1889 this happened, and we don't think about the amount of time and actual years that is. So from the bucket shops started appearing around the 1870s, okay, and finally in 1889, the New York Stock Exchange tried to address what they saw as a terrible issue, and that was 19 years that these about 20 years that these bucket shops were in existence with no hindrance whatsoever. It was just going on. It was part of life. When something's going on for 20 years, it basically becomes a part of life, right? And so they attempted to suppress these bucket shops by disconnecting telegraph stock tickers. This embargo instead proved a severe hindrance to the exchange's wealthy local clients, as well as the exchange's brokers in other cities across the country. It had also the surprising effect of favoring competing exchanges and was abandoned within days. Yeah, so whenever you do try to regulate and use the heavy hand to regulate down on people, a lot of times it'll come back and kick you in the butt, right? And that's what happened to the New York Stock Exchange. And, people are going to make things happen, whether or not it's accredited or unaccredited. They're going to have it happen. But what was happening is there was some market manipulation happening, of course. So, there were a lot of margin calls in there, and there were a lot of high risk margin calls. And what the bucket shop operators were finding out was when they would see patterns of their customers all starting to make margin, we're starting to make bets on certain types of stock, and they were highly leveraged out and things like that. They knew that a slight little downtick and the price of the stock could cause their customer to lose. And then what happens when they lose that money? All that money goes to the operators of the bucket shops. So whenever they would see a lot of customers or a customer with a ton of money come in and bet on a specific stock, well, they would do what was called front running. Okay. And so front running exists right now, and it's called minor extracted value. And they're trying to rebrand it as minor expected value or something like that. I don't know. But basically, miners are able to see on the blockchain whenever a transaction is coming through. And what they can do is they can jump ahead by paying a higher gas fee, I believe, and then buy a lot of something. And then it will drive the price upwards, or they'll sell a lot of something and it'll drive the price downwards, or something or another, and enough to manipulate the price. Then they'll come in behind this unknowing person and then buy or sell as well. And so what they will do is they will arbitrage on the difference on that price, but they've effectively manipulated the market. And that's basically what these bucket shop operators were doing as well, as they would see a lot of trades come in the order books for a specific stock, and all these people may have been leveraged out. So if that price were to have dipped just a couple points or whatever, then all those people would lose all their money, and their money would go to the bucket shop operators. So they would go and actually buy a lot of these stocks or actually sell a lot of these stocks on the New York Stock Exchange, then the price would drop or raise according to whatever type of position was there. And then the people who were in the bucket shops would, the bucket shop operators be, it's not us. I mean, look, it's coming from New York, like we can't help it. You just lost the bet. And then so all the money would go to the bucket shop operators, and they were constantly doing this. And so, that market manipulation ended up basically shutting them down. So so it's pretty bad, and so there is I talked about yesterday, there's a reason for regulation. There is a lot of scammy and market manipulation activity that happens, but whenever they start regulating good things like Celsius network and then start locking out all these people for not being accredited investors and not having $250,000 in their bank account, then it drives people because of their systemic discrimination. It drives people to this bucket shop like activity, and they're always doing these little things to manipulate and to make sure that we stay in our place and that we are not able to sit at the same table with the wealthy. But the funny thing is PayPal, for instance, they are running what is kind of a bucket shop operation. You can, say for instance, and I found this on Reddit as well about Robinhood. Robinhood's kind of a bucket shop operation. Here it says here, Robinhood is a dirty bucket shop. They claim to offer cryptocurrency but don't support deposits and withdrawals. Yesterday they locked users from trade GME just because they can. All right, so, and this was written a year ago. My mom had some money and some Bitcoin and some Ethereum on PayPal. She was not allowed to withdraw it. And as far as I'm concerned, PayPal never bought the Bitcoin or Ethereum. You're allowed to put your money into PayPal. You're allowed to buy stocks and sell stocks, or buy crypto and sell crypto. And I think some stocks, you're allowed to buy Bitcoin and sell Bitcoin. But as long as it's in and out of the US dollar, and as long as it's on the PayPal platform. So you never get the keys to that crypto. You're never allowed to withdraw the actual Bitcoin or Ethereum, and you're never allowed to have actual physical possession of it, like the keys to your crypto. And so as far as I'm concerned, you've never bought that Bitcoin or Ethereum, and they are basically a bucket shop. You're buying you're buying the bucket shop piece of paper, the PayPal ticker, the PayPal ticker paper, and you're buying that and you're holding on to that, and you're just basically speculating on the price, and that's it. And if you want that Bitcoin, well, tough titties, you're not getting it. If you want to cash out, you can cash out at the new price, sure, but I mean, they might not be front running and manipulating the market. Maybe they are, but you don't own that Bitcoin. So it's basically no better than a bucket shop. And then Robinhood is the same way. Robinhood is a dirty bucket shop. Any website service that allows the trading of crypto but no deposits or withdrawals equals immediate scam warning. Withdrawals have been promised. It's coming. Yeah, they always say that. For 2 years in Robinhood, but it's not yet there. Today, they stopped users, mostly retail, from trading GME, and the price crashed from 500 to 300, but large institutions can still buy on their institutional brokers now at a much cheaper price. Robinhood has effectively manipulated the market by locking its customers out and aiding the institutions who need to buy GME to cover their shorts. So you see what happens, this type of aristocracy, snobbery behavior, this institutional privilege and all that stuff, and institutional systematic discrimination, it perpetuates this bucket shop type of activity, and it perpetuates things like tulip bubbles, and that the funny thing is tulip bubbles, look at how many. I just Googled tulip bubbles never existed, and I couldn't find a single video about really how tulip bubbles never existed. There was a tulip bubble of sorts, okay, and I'll explain that here in a second. But a lot of people, out of kind of desperation, wanting to become rich, started to perpetuate this whole activity of a tulip bubble. But look how many videos there are about this tulip bubble and explaining what happened and all that stuff. It just goes on and on and on and on about the tulip bubble, and everybody explaining tulips. And a lot of people compare the Bitcoin and crypto bubble that they say we're in. It's been 12 years now. Tulip bubble lasted 6 months, and they compare Bitcoin to a tulip bubble. A lot of people I've heard compare IoT, Internet of Things devices, to tulip bubbles. It's not a bubble. Like, IoT is not going anywhere. Between IoT, cryptocurrency, AI, RFID, all that stuff is an entire new paradigm, a new system, decentralized ID, that's all moving in, and it is not a bubble, folks. All right. So anyway, so let's look at I found this article here. Okay. First of all, this same podcast, right here on, I would highly recommend, I'm going to link this podcast that you guys listen to, the Stock Market Bubbles with Jamie Catherwood, the Investors Podcast Network. And this is episode number 427 on March 3rd. It is really good. And he talks about the tulip mania. And there's a book that was written by, let's see here. Where is this book here? University of Chicago Press by Anne Goldgar, Tulip Mania, Money, Honor, and Knowledge in the Dutch Golden Age. And she explains the entire tulip bubble and how it really wasn't as all these videos that I just showed you explained. There's tons of videos explaining the tulip bubble like it actually happened. It did not actually happen that way. And there's an entire book on here, and he in this podcast will explain that for you. I'll play a little snippet of it here.
There's no questioning that people were buying and selling tulips, and there were probably some ridiculous prices paid for them. But there's kind of three issues. So the first issue is that mainly people today get their idea of tulip mania from Charles Mackay's Extraordinary Delusions and Madness of Crowds, or whatever the title is. And the problem with his research was that it was based on largely the work of a German writer in the 18th century. And that German writer had gotten most of his kind of source material from these pamphlets and circulars that were kind of floating around at the time of the Dutch tulip mania. And they were all satirical. And so,
okay, so yeah, what he was saying is the whole idea of the tulip mania that Charles Mackay wrote about, which is the source material that all these videos are getting it from, and he explained people losing everything, that people were paying, what's worth a house for all that stuff and all that stuff. Well, Anne Goldgar went back and did the actual research of Charles Mackay, and then what his sources were, and Charles Mackay's sources were a German writer, and the German writer's sources were just a bunch of pamphlets, satirical pamphlets. It would be like using the Onion or Babylon Bee as actual source material, and just total exaggeration, total humor. And I saw from another source writing about this as well, that the Calvinist churches in the Netherlands at the time were also writing against it, and they were basically taking a moral approach, and it was all that stuff was controlled by the aristocracy. They did not want the average person, the citoyen, to be able to have money and to be able to sit at the same table with them, because they did not like all this new money coming in. They thought the new money was tacky. There were the landowners, and then there were the merchant class. And the Dutch at the time were this whole new class of wealth brought in from the whole Dutch Empire, and the merchant class were moving up, and they were kind of supplanting in that region the established landowning nobility. And so a lot around that time, this is when the tulip mania was happening. The tulips were originally from, I guess, around the Himalayas area, around Nepal, and then they were taken to the Ottoman Empire, and in Turkey, I can't remember the name of that king, but he had a huge tulip garden, and so they were basically imported. And you had societal status if you were able to have imported exotic goods and things like that. So a tulip was exotic, and they were kind of like NFTs. I mean, you didn't know what you were getting out of your bulb until it actually bloomed. And then if you bloomed and you got some cool color, like solid colors were cool. Yeah. You had a tulip. But if you got a weird one, and there was this little virus that was inside the plant sometimes, and infected plants would create these weird colored patterns and stuff like that. And if you got one of those were definitely worth more. So there was like a value for the tulips. I'm not saying that tulips never had any type of extravagant value, but what I'm saying is that the whole idea of them having tulip fevers and people sitting here doing all these like crazy futures contracts and everything like that, and losing their entire wealth and betting their houses, and that this was permeated into all the lower classes from the chimney sweeps on up, like that's not really what happened. It wasn't that crazy, and it was maybe a tiny blip on the map. But Charles Mackay, when he wrote that book, obviously he's a great storyteller, and the German author that he used as his source, sat there and took for fact all the stuff that was in the satirical pamphlets at the time, and from the tracts of the Calvinist church at the time, and yeah, those were exaggerations. It was propaganda used by the wealthy class to sit there and deter people from this type of activity, because people were basically doing derivatives contracts and futures contracts in basically what amounted to bucket shops, pre-bucket shops in the Netherlands, betting on these contracts with the tulips, right? And so once again, the establishment and the aristocracy was trying to use propaganda and to use fear, uncertainty, and doubt, and FUD, and then regulation to be able to try to keep people from basically becoming wealthy. So yeah, it's really interesting. And so let's see here. According to popular legend, I made some highlights. The tulip craze took hold of all levels of Dutch society in the 1630s. The rage among the Dutch to possess them was so great that the ordinary industry of the country was neglected, and the population, even to its lowest dregs, embarked in the tulip trade, wrote Scottish journalist Charles Mackay in his popular 1841 work. Extraordinary Popular Delusions and the Madness of Crowds was the name of the book. That did not actually happen. According to this narrative, everyone from the wealthiest merchants to the poorest chimney sweeps jumped into the tulip fray, buying bulbs at high prices and selling them for even more. Companies formed just to deal with the tulip trade, which reached a fever pitch in late 1836. But by February 1637, the bottom fell out of the market. More and more people defaulted on their agreement to buy tulips at the prices they promised, and the traders who had already made their payments were left in debt or bankrupted. At least that's what's been claimed. And in fact, there weren't many people that were involved in the economic repercussions, and the economic repercussions were pretty minor. Goldgar says, I couldn't find anybody that went bankrupt. If there had been really a wholesale destruction of the economy, as the myth suggests, that would have been a much harder thing to face. It's not to say that everything about the story is wrong. Merchants really did engage in a frantic tulip trade, and they paid incredibly high prices for some bulbs. And when a number of buyers announced they couldn't pay the high price previously agreed upon, the market did fall apart and cause a small crisis, the tulip market, but only because it undermined social expectations. In this case, it is very difficult to deal with the fact that almost all of your relationships are based on trust, and people said, I don't care that I said I'm going to buy this thing. I don't want it anymore, and I'm not going to pay for it. There was really no mechanism to make people pay because the courts were unwilling to get involved. And back then, you got to think about it. Your word is your honor. Your honor is your title, and your title is your place in society and your claim to ownership on property in life. So people to going back on their word at that time was a lot more significant than I guess something now, but the trade didn't affect all levels of society. It didn't cause the collapse of industry in Amsterdam and elsewhere. As Garber, the economist, writes, while the lack of data provides a solid conclusion, the results of the study indicate that the bulb speculation was not obvious madness. So if tulip mania wasn't actually a calamity, why was it made out to be one? We have tetchy Christian moralists to blame for that. The Smithsonian blames the Christians, but the other guy, Jamie Catherwood, he says, it's the satiricists as well. I don't know why the Smithsonian would be, only pointing the finger at the Christians, but it's people writing satirical articles as well. But anyway, they say we have tetchy Christian moralists to blame for that. With great wealth comes great anxiety, or as historian Simon Schama writes in The Embarrassment of Riches, an interpretation of Dutch culture in the Golden Age, he writes, the prodigious quality of their success went to their heads, but it also made them a bit queasy. All the outlandish stories of economic ruin, of an innocent sailor thrown into prison for eating a tulip bulb, of chimney sweeps wading into the market in hopes of striking it rich, those come from propaganda pamphlets published by Dutch Calvinists worried that the tulip-propelled consumerism boom would lead to societal decay. Their insistence that such great wealth was ungodly has even stayed to us this day. So it has a lot of religious connotations, but a lot of the people that were the most religious in that society were also the most wealthy, and they can't be having the wealthy, the new money moving on up. I don't know. Anyway, this is kind of a ranty episode, but it's just, this whole idea of accredited investors and how, regulation tends to kind of force people to sketchy and criminal activity. And I'm not saying that criminals are blameless, but there is systematic structures in place to make sure that, I don't know, man. It's like recidivism, I think, is the term, when people who go to prison always end up going back to prison, because that's in a way the place where they actually finally feel secured and cared for. And so they become perpetual criminals, and the system has made them that way. And are we, as non-wealthy people, kind of cursed to engage in this degen financial activity, because we have no other choice, because we're not accredited investors? I don't know. It's just morning ponderings at 6:16 to 7:02 a.m. I've been going on that long, 46 minutes. I don't know, man. I sit here and have this entire conversation with myself. This is my morning meditation, and you're just like voyeuristically listening and watching. All right, man. Well, I will, tomorrow I'm going to interview several people from the Cafe DAO, and it's a new DAO starting up in the Seattle area, in which they are opening up coffee shops based on DAOs. So it's interesting how coffee has really tended to be the starting point for a lot of new and different business tactics. And a lot of times they start with coffee shops. So we'll talk to these people tomorrow and see what they have to say about it. All right. With that being said, let me go ahead and get on out of here. I'm going to start the day, and it'll be a good Friday. It will be a good Friday for sure. Yeah. Even if it's not a good Friday, it's Good Friday. All right. Well, I will talk to you guys tomorrow.
Thank you for making it to the end of this program. If you actually like this content, give a thumbs up. And if you want to hear more, just hit the subscribe button. I'm available on YouTube, Odyssey, and BitChute, and on all the major podcasting platforms in audio version. Spotify specifically. If you would like to follow and leave a review, that would help a lot. I am also available on Twitter at EurekaJohn1. That's EUREKA John, JOHN, and the number 1. My DMs are always open. Feel free to shoot me a message. Thanks again.